If you're a business leader, you know the feeling. Managing the company's finances can seem like you're juggling chainsaws on a tightrope. It's this incredibly high-stakes balancing act between just surviving day to day and actually building for the future. You get it right, and you thrive. But if you get it wrong, well, the results can be pretty brutal. And hey, this isn't just a hunch. It's a hard reality. A huge survey from EY found that over half, more than half, of chief financial officers think their entire way of handling capital is just plain outdated. The old playbooks, they're just not cutting it anymore in this crazy, fast-moving world. So with all that pressure, where in the world do you start? How do you build a financial strategy that's not just going to hold up, but is actually built to fuel real, sustainable growth? Well, that's what we're going to break down today using a really powerful 4-pillar framework. We're going to cover mastering your cash flow, investing for future growth, building your human capital, and of course, optimizing your bottom line. And you're definitely going to want to stick around to the end because we'll show you how to tie this whole thing together. Okay, first up, pillar 1, cash flow. You have to think of this as the lifeblood of your business. It's the engine that runs everything day to day. Without a healthy cash flow, even the most amazing long-term vision is, let's be honest, dead in the water. And this is an area where some really cool modern tools are changing the whole game. Take supply chain finance. You've probably heard of traditional trade finance, which is mostly about managing risk for international shipments. But supply chain finance? That's all about freeing up working capital for both you and your suppliers, whether they're across the street or across the ocean. And check out how simple this is. Your supplier delivers the goods, you approve the invoice. Then a third-party finance provider steps in and pays your supplier early. This is huge for them. Meanwhile, you get to hold onto your cash and pay the finance provider on your original longer terms. It is a total win-win that keeps the entire supply chain running smoothly. Of course, cash flow isn't just about money coming in. It's also about managing what's going out, like corporate debt. And the two classic strategies from personal finance work here too. You've got the avalanche method. Tackle the highest interest debt first. On paper, it saves you the most money. But then there's the snowball method. Knock out the smallest debts first to get those quick wins. It builds momentum and can be a huge psychological boost for the whole team. All right, on to pillar 2. So once your daily operations are humming along nicely, the game shifts. Now it's all about investing for future growth. This is where you start placing your bets on what's next. But wow, is it tough. That same EY survey pointed out the biggest headaches for CFOs. And you can see it right here. The #1 challenge is just keeping up with changing customer demands, followed really closely by not being able to forecast accurately and not having access to good data. It's like you're trying to hit a target that's constantly moving and hiding in a fog bank. So what do? You use a structured framework. The pros use sophisticated models like these to bring some order to the chaos. For instance, a factor-based approach goes deeper than just stocks versus bonds. It looks for hidden risks, like realizing your entire portfolio is way too sensitive to interest rate hikes. These frameworks are all about adding discipline to what can otherwise feel like just a gut decision. And that brings us to pillar 3. And this one, honestly, might be the most overlooked financial lever of them all: investing in your people. Your team is not an expense line on a spreadsheet. They are your single most critical value-creating asset, period. And if you're not quite sold on the financial impact, just look at this number: $240,000. That's what a single bad hire can cost a growth stage company when you factor in salary, training, and finding a replacement. That one mistake can kill your momentum for a year or more. Getting hiring right is a massive financial win. And this chart just hammers the point home. What's the #2 reason startups fail right after running out of cash? Team issues. Almost a quarter of all failures boil down to not having the right people on the bus. See, this isn't some soft HR thing, it's a hard financial reality. So how do you avoid that trap? Well, you start by steering clear of these common mistakes. Things like hiring just to hit a headcount number instead of focusing on the return on investment of that role. Or maybe the biggest one, hiring for the company you are today, not the company you need to be in 18 months. You have to be playing chess, not checkers. All right, let's move on to our final pillar, pillar 4, optimizing your bottom line. This is all about being smart and making sure you're not leaving free money on the table. And trust me, the tax code is full of opportunities if you know where to look. Let's start with a really big one: Section 179. This thing is fantastic. It lets businesses deduct the full price of certain equipment right away, up to $1.25 million. For companies that buy a lot of gear, this is a huge lever for improving your cash flow by lowering your taxable income today. And wait, it gets better. You can stack another benefit right on top of that. For any costs that go over the Section 179 limit, bonus depreciation lets you immediately write off another 40% in 2025. You use these two together, and you can write off a massive chunk of your equipment costs in year one. It's a game changer. Now, here's a myth I really want to bust. So many business owners think the R&D tax credit is just for scientists in white lab coats. No way. If you're improving a process, building a prototype, even writing software, you might qualify. And this is a credit, not a deduction. It's a dollar-for-dollar reduction of your final tax bill. It's incredibly powerful. Even your hiring strategy can directly help your bottom line. The Work Opportunity Tax Credit gives you up to $9,600 for hiring people from certain targeted groups, like military veterans. It's one of those rare things that perfectly aligns a smart financial move with doing something really good for the community. Okay, let's bring this all home. We've talked about 4 separate pillars, right? Cash, capital, people, and taxes. But the real magic, the secret sauce, happens when you stop seeing them as 4 different things and start seeing them as one integrated, interlocking system. So if you remember one thing from all this, let it be this. Your business doesn't work in silos, so your financial strategy can't either. When you decide to buy that new piece of equipment, that's not just a capital decision. It hits your cash flow, it changes your taxes, and it affects what kind of people you need to hire. It's all connected. And to really make this idea stick, I want to leave you with a concept from personal finance called lifestyle creep. You know exactly what this is. You get a raise at work, and suddenly you're spending a little more here, a little more there, and a few months later, you're looking at your bank account wondering where all that extra money went. That is the perfect analogy for what happens inside a company. A business that isn't disciplined, that lets costs creep up without a clear ROI, that hires without a strategy or ignores easy tax savings, is suffering from its own kind of corporate lifestyle creep. It's just wasting resources that should be fueling growth and building a stable future. This integrated 4-pillar strategy is the antidote. It's the discipline that forces you to manage your cash, invest wisely, build the right team, and optimize every single dollar. Ultimately, it's what separates the companies that last from the ones that don't. It ensures your business's financial health is built for the long haul. Which leaves just one last question for you to think about.